Good day, everyone. How are we doing? Thank you all for sharing your time here with us in our Sunday webinar. Looking forward to getting to it, getting into what it is we'll be looking for this week, what we'll be watching moving forward for our forecasts, expectations, and what we'll be looking to trade this week. We also have some interesting educational segments we'll be doing, going over a live trade that I took this week using my favorite trading model that I shared and created a video on for you all this past week. So with that being said, we'll get right into our intermarket analysis, share what we're seeing and why. And another thing, we also have these COTs that finally have been released this previous week. So we'll go ahead and get into that because we also like to use COT reports in conjunction with our technical analysis. So with that being said, I'm going to go ahead and get right into the analysis for the dollar index and read the COT analysis that my associate has written up for us to also keep in the back of our mind while we're trading this week and doing our technical analysis. So the COT reports are out again, starting from the open interest perspective with respect to the dollar. Open interest, we have flipped negative. This, in conjunction with market trend, can signify a reversal or short-term reversal. So what we know is the dollar might see some upside movement going into the new week. Speaking of the changes from last week, more shorts were removed by non-commercials than longs were. This shows profit taking and can be met with upside movement on the charts, as we are likely to see. In conclusion, bullish dollar next week according to the COTs. And then now for the S&P COTs, interesting week this will be. More shorts have been fiercely added to the ES with over 10,000, while longs were removed in large quantities. A whopping 80,000, negative 80,000 in open interest. With all these, we can see more downside on the S&P going into the new week. So COT reports in conjunction with technical analysis is the way to do it. Just simply trading off COTs isn't enough information, but this in conjunction with technicals will give you a very clear outlook for midterm to long term, as most of these non-commercial and commercial traders that the COTs is giving us insight into are typically trading higher time frames. So this does give us directional weekly daily bias. So with that being said, going right into our dollar index analysis on the weekly. So we have had a deep retracement for about the past 4 weeks. We have had a retracement down into the impulse leg we have created in the month of starting in February. So we've had a deep retracement, and looking at where we retraced to, as my colleague was sharing, we retraced down into the optimal trade entry and reached the low end of that, and then we quickly came off those lows. So some things that are noteworthy going into this week for the dollar index is looking at the balanced price range that we've been looking at these past few months, really on the downside and then on the upside. We've seen that price has wicked below it, but we closed above the 50% of that level, which is indicative of strength. So the fact that we closed above the balanced price range. Also, we have a discount fair value gap that have also closed above, and one other key level being the consequent encroachment of this wick. So the 103.82 level. And then notice how the bodies of the candles closed above this key level. So we've closed above several key levels that we wouldn't want to see violated if we are going to expect continued bullishness. Another thing to note here for the dollar index is we do have an SMT. As my associate pointed out ahead of this meeting, we have the 10-year yield that made a lower low, while the dollar index failed to make this lower low. So this is a key SMT that gives us insight into this coming week. So we have several key measuring points that are indicating bullishness for the dollar. Dropping down into a daily chart now. I'll leave that on there. So here we have this fair value gap. This was the last of this BISI that was left unbalanced because as we see here, we've traded lower. So we rebalanced this portion. So we've now traded lower and have rebalanced the rest of this price range. So we've dropped down to the pit of the low end of this BISI. We've rebalanced it and then we've immediately traded higher. One other thing I did want to point out, taking off this fair value gap, we also have seen a strong move higher off the bullish breaker. So we've traded down into the bullish breaker, into the SIBI, also bullish order block, and then we've seen a strong reaction higher. And we did get a closure above this SIBI right here. So going into this week, I do expect upside continuation with everything we've looked at with the COTs, the weekly, as well as the SMT. We have closed above this key SIBI level. So now that we have taken out these relative equal lows, sell side liquidity, reached a discount, smart money, if we are bullish, accumulated inside of this bullish order block and bullish breaker. So going into this week, we now have a SIBI here, and we will see if this creates a balanced price range depending on if this next candle opens and does not trade below it. But what I will want to see going into this week is this should be a key low if we are to remain bullish. I would not want to see price come down and close below this SIBI, as that could indicate that we are going to continue bearish, and that would give us key insight that then we'll have to look into and adjust what it is we're looking to do. But moving into this week, I am expecting bullishness, but I would not want to see this key level violated. And if it is, as I said, that'll be critical insight that then we'll have to adjust what we're doing. So on the upside, for dollar index, my first target will be this SIBI in here, this fair value gap. So first target on the dollar will be the 103. Oh, okay. Let me change it. Are you guys able to see this one better now? Awesome. Thank you for letting me know, sir. Okay, awesome. So yes, so this was the SIBI I'm talking about. So I do not want to see closure below this. We can drop into it and find support. However, we should not close below this level. This should be a key low because it's already taken sell side and has dipped into several discount arrays. So on my upside objective for this week on the dollar index, first objective will be this SIBI. So my first target will be the high of this candle, which would be the 103.5 level. That'll be my first upside objective, and then a full fill of this SIBI. And then we also have the opening price of this bearish order block at the 103.7. My third objective on the week will be the mean threshold of this bullish order block, which would be the 104.273. So those would be my upside objectives on this week. And what I do want to see is expansion through these premium arrays. So I would want to see us potentially get above this fair value gap, find support to then continue higher. I wouldn't want to see price trade up into these key levels, get heavy, and then trade off those highs. So I would want to see expansion through these key levels. And then my final objective on the week will be this inefficiency here, volume imbalance, as well as the swing high in here. And before moving on, one other thing I did want to touch on. So going into last week, we did have this bearish breaker in here. Buy side taken, displacement lower through the swing low. Price has traded into the breaker, and then we rejected and traded that lower until we reached into discount. So I will want to see speed and acceleration through these premium arrays, being the order block and the breaker. And I do want to see price gravitate and seek premium, being the buy side liquidity here and above this high as well. Dropping down into an hourly chart now. Now to look at market structure. We have a intermediate term low here and an intermediate term low here. So this classifies this as a long-term low. So this low should not be violated if we are to remain bullish. Even this intermediate term low shouldn't be violated here. So if we do start getting down to these key levels and violating them, that will give us insight that then we'll have to adjust and then get in line with potential risk on. However, I am favoring risk off going into this week which is higher dollar, lower foreign currency, lower indexes. So looking at the dollar index, we have a fair value gap in here in discount. I would want to see price drop into here and find support to then continue higher and take out this buy side liquidity here. And if we look at the dollar index, we do have pretty clear trend line liquidity from here to here. So there's quite a bit of trend line liquidity here that I will want to see price expand into. However, price should find support inside a discount arrays and continue higher. And then as I've shared here with the market structure is also supporting what it is we're looking for moving forward here with the dollar index. So now going into the 10-year yield on a daily chart. So price has traded lower off the premium SIBI fair value gap that we have rebalanced. We've traded lower, attacked sell side liquidity. And then we took out sell side once more, taking out this low here. So what I did like to see on this move lower we saw Friday is I like to see how we took out that low and then immediately traded off those lows. Another confirmation of bullishness on the interest rate market is the 30-year yield SMT. So here we see that the 30-year yield was actually unable to get below these relative equal lows or the low formed on Monday that the 10-year yield took out. So we're seeing critical SMT between the interest rates. And also looking at the 30-year yield, we see that this body or the body of the candle was actually unable to get below the consequent encroachment of this wick. So 50% of this wick supported price, which is bullish price action. So in summary, I'm expecting risk off, higher dollar, higher interest rates, lower everything else. And going right into the looking at T-bonds real quick here. One thing I did want to note is how the bodies are respecting this fair value gap here perfectly. So we are seeing that the bodies are unable to actually get above these highs. What I would have preferred to have seen last week. Hey, Joe, absolutely. Yep, I'll go over the ES. That's something I cover usually every session. So I'll be sure to get to that and give you an in-depth analysis on what I'm expecting for the ES. So looking here at the T-bonds, we see the bodies have been unable to close above this key fair value gap. So as I was saying, what I would have liked to have seen last week was a wick above these highs, take out this buy side liquidity to then resume lower. But now we see we have relative equal highs here. So this wick higher did take out this high, but this high has been left intact, that liquidity there. So what we could potentially see this week is an opening, a Judas swing, manipulation higher to take out that buy side, and then continuation lower. But that's something I'll be monitoring here in the T-bonds as well as the dollar. I will want to see upside acceleration and continuation to confirm our risk off bias. Now moving right along into the ES on a weekly chart. Okay, so we did have a up movement last week. It was extremely lethargic without much speed. So what I did want to note is the close of this week. We closed right on the open of the bullish order block, or bearish order block, I mean. Okay, awesome. So if we see the opening price right here, the opening price of that candle is 40.10 and a half. And then we see our closing price here is 40.10, that close right here, 4,010.5. So what I was sharing last week and took everyone's attention to was if we are to remain bearish on ES, we should not violate this level. Wicks are fine, wicks are permitted. That's where the damage is done. The real narrative is told in the bodies of the candles. So here we see a wick higher, but we see respect for this key level precisely. So going into this week, assuming we respect this key order block level and we continue lower and dollar rallies, we do have relative equal lows here on the ES on a weekly basis. So I will want to see a rapid expansion down into these lows. I don't want to see price get lethargic and slow, I want to see aggressive expansion lower to accumulate that sell side liquidity. And a big reason that the market likes to expand quickly before right when it's about to reach liquidity is because it doesn't want to offer the people that have stops below those levels or orders a chance to pull them. So it wants to go reach for those orders quickly before people that have stops or short orders in there are able to react to that. So that's what I'm seeing on a weekly chart, dropping right down into a daily. Wet my whistle real quick. Okay, so on a daily chart, we have seen a slow move higher. What I do want to point out is notice the energetic expansion that we see on the downside. Price is moving aggressively lower with a lot of energy. We see displacement with several volume imbalances, fair value gaps on the move down. And then notice the move up, how lethargic it is, no fair value gaps, no volume imbalances, no speed to move higher. So we are seeing this as weakness in the ES. Absolutely, Jang. I'll be sure to check out the NASDAQ for you. So yeah, so looking at the ES here, as I've said, we are seeing a lethargic, slow move higher. What this looks like to me is the market trying to sucker in more longs, get people to think the market's reversing. There's several reasons why the market would want to go lower. We have sell side liquidity here below these relative equal lows. So retail is seeing that as support to continue higher because this is exactly what the retail books are telling them. Draw a line across from where the market bounced last time, and then it should do that again. So we are looking to target those individuals that are willingly placing their stops at those levels. So we have relative equal lows, price is respecting premium levels, and we also have trend line liquidity. We have perfect trend line liquidity here that retail is also seeing a support, and they want to see continuation off these levels. So there's several reasons. The phantom trend line, double bottom, support. We do want to see the market rip through that. And what we're internalizing this as smart money traders is the market was just going to premium. Why is the market offering a premium? Because we want to get short, or smart money wants to get short in that premium to then attack those individuals that have their orders down here. So one thing I did want to notice looking at the price action, I did want to take our attention to is looking at the price action from last week. We still had a little bit of an efficiency here that was not rebalanced. So we have the CIBI, price traded into it and then rejected it strongly. So price reached up for a premium, and then we saw a key rejection of those levels. And then another key level that I took all of our attention to last week was this bearish breaker. So I'm going to drag this over. So the 2 consecutive down close candles before the move that took out buy side to then displace lower and shift the market structure. So here we see the bodies of the candles were contained inside of the breaker, which is a bearish signature. Remember what we've just discussed. The bodies of the candles tell the story. The wicks are where the damage is done. So this wick here took out buy side and repriced to this premium inefficiency, but we are seeing the bodies being contained inside of the breaker, which is a bearish signature that we do want to see. And then we see price drop lower and closed below this key level. So going into this week, I do want to see how price trades inside of these key levels. I would not want to see this breaker violated or the CIBI fair value gap above here. Price has no reason to revisit those levels if we are to remain bearish. And then if we do overtake these levels, that's clear indication and intel that we could potentially be seeing higher prices, but that would also be met with a lower dollar. So there's a balance of things that we're measuring here. And one thing that I did want to point out is algorithmic theory relies a whole lot on if this occurs, then that should happen. So it's a lot of if and then syntax because everything needs to be binary. The way this algorithm's internalizing price and delivering it is on an if-then basis. So if this level holds, then it will attack sell side. If we overtake these premium levels, we're likely to see a change in the state of delivery to bullish to then attack premium. So whenever we're doing analysis, it's a lot of if-then syntax for the internalizing of price delivery. So one other thing I did want to point out here for in the NASDAQ is it actually gave us a really nice SMT. And then for those of you guys that are actually in the Telegram, you guys saw that before we actually took out these highs, I sent in a update that I am expecting when we were down here. I shared with everybody I was expecting NASDAQ to actually take out these highs and buy side liquidity. So why is that? It's a convergence of several factors. So now this is where fundamental analysis comes in. So if we look at the interest rates, you guys have seen that that has been dropping quite a bit. So here we see interest rates have been extremely bearish into these past couple weeks. So what does that tell us with regard to indexes? So what is the NASDAQ 100? It's the 100 tech companies of the United States. So what do we know about tech companies? Tech companies operate on a very high debt margin, meaning they are companies that hold lots of debt, and that's their business model. So the reason that's significant in regards to the NASDAQ and trading is because if interest rates are dropping, that means tech companies have less debt payments to service the debt they've taken out. So that is bullish for tech companies seeing interest rates fall because it's better for their bottom line. So this is how I was able to confidently tell you guys that the NASDAQ is likely to take out these highs, while we see the ES was very lethargic and slow to rally. And we even see here that the Dow has been even more lethargic. It hasn't even been able to get above that breaker here. So we are seeing the index is still extremely heavy. And now we even have a key SMT to confirm what we are looking at. So for those of you guys that were in the chat and saw what I shared, I was also predicting this being an SMT and giving us key insight into what to expect in the coming week. So we can even anticipate SMT if we know what it is we're looking for. So that's how I was able to give you guys the prediction that NASDAQ is likely to take out these highs. And assuming the ES and the Dow failed to, that will give us key insights moving further into the week. So downside objectives for the ES this week. So first, this trendline liquidity. I do want to see this taken out. That will be my first objective, is to dip it down into that phantom trend line. My second objective, and this will be clear on the lower time frame charts, I'll just show it right now. So looking at the 4 hour, we have relative equal lows here. So first objective on the week will be these relative equal lows. Going back up into a daily chart. Once those relative equal lows are taken, I do want to see acceleration on the downside to take out the sell side liquidity below the relative equal lows here. So that sell side liquidity will be my second objective. And then assuming we get further downside acceleration, we do have sell side liquidity also below this low as well. So that's what I'll be looking for into this coming week and what I'll be expecting here for the index markets. Now going into the NASDAQ to do analysis on there. Let's go up to the continuous contract. So another thing to look at and consider why the NASDAQ has been rallying, it's because it's much further behind the ES and the Dow. So if we look here, when the Dow rallied higher, Dow right here, so we see here that the Dow actually was much more bullish, and we could have determined this with the SMT here. The Dow actually failed to make a lower low while the other indexes did, but the Dow was much more bullish in the fall months. And then when we compare that to the ES, it was much less bullish. And then the NASDAQ was even less. So the reason the Dow has been much more bearish, it's because it's been having to catch up with the NASDAQ, which was already down here almost at the yearly lows, and the S&P, which was also much lower than it. So the same logic, vice versa, we will apply to the NASDAQ. The reason it's been much more bullish is because it's much lower than the other averages when we compare them to one another. So we see here that the NASDAQ has actually been much lower relative to the Dow and the ES. So it's going to want to rally more to be able to catch up to regain the market symmetry between the indexes. So a lot of game given out here. Hope everyone had the notepads out. So now going into the analysis for the NASDAQ. So here we see the NASDAQ has taken out the high. Now let's look at the official contract. Okay, so we see here the NASDAQ has taken out the high. What we could see going into this week is now we do have relative equal highs. So we could potentially want to just sweep that once more before going lower. But what I will want to see is a rejection of these highs. I don't want to see price run through it and close above it with strength. I want to just see price sweep it and then continue lower. I want to see price also drive through these discount arrays, being this BISI in here, as well as this bearish order block or bullish order block. So my targets on this week for NASDAQ, assuming we potentially get a manipulation Judas swing above these highs, I will want to see my first objective will be this BISI and then this bearish or bullish order block. And then assuming we get speed on the downside, we have this swing low and relative equal lows here that I will want to see delivered to for the NASDAQ. And then this is also will have to be in conjunction with a higher dollar. So there's a lot of things to be considered when determining daily bias, midterm to long-term outlook. You have to take into account several factors, being intermarket analysis, intra-market analysis, as well as the technicals in the respective asset you're trading. So I believe someone wanted me to take a look at the euro and the British pound. I know we have quite a few Forex traders in the group, so I'll be sure to I'll start including this in every week's analysis. So looking here at the euro, very similar to what we're seeing in the dollar index. So strong rejection here of this city on a weekly. Appreciate it, Jang. Thanks, brother. So looking here at the weekly chart, we are seeing closure below this key level. We now have relative equal lows here that I will want to see price drive into. That'll be my draw on liquidity for the weekly chart. And then there's nothing much more here on a weekly that has my interest. So jumping down into a daily. So what I shared with you all last week is that there was a key SMT here between the euro and the British pound. So let me show that comparatively. GBP. Okay. So here we see the British pound actually took out this swing low, whereas the euro was unable to. So this was confirmation to anticipate a rally into premium because we saw this key SMT, and the dollar was also having a deep retracement into a discount. So we traded higher. My premium objectives that I shared with you all was this swing high here, assuming we got continuation, and then this bearish order block. And that's where I wanted to see and get key intel from to see what price is likely to do moving forward. And then we do see that price has rejected the bearish order block beautifully. And then we have traded lower off those highs down into a bullish order block. So what I am seeing here for the euro is delivery back up into a premium, same way we saw in the dollar, delivery into discount. Now I want to see how price reacts. I want to see price aggressively expand lower. What I will want to see is how we react inside of this bullish order block. So the sensitive levels I'll be looking for is the open and the mean threshold. So the mean threshold of that bullish order block will be the 106,381 level. So what I will want to see is how price trades at that level. Do we drop into it and then rally, or do we smash through it and close below it? That's what I'll want to see going into this week. So my first objective for the euro will be this BISI in here, this fair value gap at the 107.40 level. And then the high of that, or the low end of that fair value gap, would be the 106.072 level. So that'll be my first downside objective, and then the mean threshold. And then assuming we get acceleration through these levels, these relative equal lows here have a lot of orders and liquidity resting below them that I will want to see price deliver into. Appreciate it, Tommy. Thanks, brother. So yes, that's what I'm seeing here. And then one other thing, we do have a fair value gap in here. That price was also unable to close above. So we are seeing key reactions at specific levels that we do want to see, and it has given us intel as to what to expect into this coming week. Going into the British pound now. Thank you, sir. Glad it's helpful, and I appreciate the feedback. Okay, looking at the British pound right now. So as I've said, key SMT here at the lows. So that's a likely cause for rally. What's another indication that we would have been rallying? Notice how many times sell side was taken. So we had sell side taken here once, twice here, 3 times, and then 4 times taken out these lows. So sell side liquidity's been ran out several times. So that's indicative that we are potentially going to see a retracement higher, because if sell side liquidity was taken multiple times, that'll want to be offset with buy side liquidity. And then we've seen delivery up here into a premium, relative equal highs here, as well as this swing high. And then we've delivered into the bearish order block. So multiple factors that indicated a likely retracement was in the cards was the several purges of sell side liquidity that were shallow runs, and then we would expect retracement, and then also the SMT. So the key levels I shared with you all last week that I was expecting was this swing high to be taken, and then that was actually just delivered on Monday. So we took out this buy side liquidity here, and then we actually reached into the bearish order block in here. And then note the respect for the mean threshold. So the mean threshold is the 102.331 level. So yeah, that's close enough. So the mean threshold level, look at how price bumped it once more, and then rejected lower off it. So we didn't get a close above this key level. If we do get a close above that going into this week, that is likely to lead to a deeper run into the buy side above here. However, gauging from the reaction we have seen off this bearish order block, I am favoring lower prices. But the key levels I'll be monitoring on the British pound will be, we have the volume imbalance that we have in here. I would want to see price go below that. We also have a bullish propulsion block. This is a propulsion block because it's an order block nested inside of another order block. So the sensitive level of the propulsion block is going to be the high and the open of the candle, as well as the mean threshold. So if we do find support and we're unable to get a closure below this propulsion block and the volume imbalance, that would indicate that we are likely to continue reaching higher for this buy side liquidity up here. So these are the key levels I'm monitoring, and what specific levels I'll be looking for to monitor order flow. And remember what I shared earlier about the if-then syntax and why it's important to do your technical analysis on an if-then basis, as that's exactly what IPDA is doing. So that's what I'll be seeing here for the British pound, assuming we get acceleration on the downside below these key levels and the dollar wants to play, meaning risk off. I will anticipate delivery down into these lows that were created on the move up. So this low here at the 102 level, and then I would favor this BISI fair value gap being delivered to here for my downside objective. And then let me take a look at the Telegram, because I know some people wanted me to look at some different assets. Soren wants me to take a look at gold coming right up. And then Shinsandi, you want me to look at balanced price range. Okay, I'll cover that after gold. So gold's been interesting. When gold moves, she moves. So you need to do an example of dealing range top down. So what I would actually counsel you to do is check out the video we did last week. I actually did a more in-depth teaching on dealing ranges and how to measure them top down, as well as how to use the higher time frame parent dealing ranges and how they relate to the lower time frame dealing ranges. So I actually did an in-depth teaching on that and how I measure them. So that would actually be a good resource to look at dealing ranges for. So looking at gold, as I said, when she moves, she moves. So we've had a big move higher here on gold. Looking at it on a weekly chart, we've seen a nice rally higher. We've taken out these equal lows, sell side liquidity, and then prices rallied. We're gravitating towards these relative equal highs. I knew these highs would be a factor in the coming months. I didn't know it would be that soon. What I was actually anticipating was a sweep of these lows before continuing higher. But gold has been very bullish, and that also has to do with a lot of the macro events going on around the world, a lot of things with lack of trust and confidence in the financial system, as well as the issues that we're having with global currencies. So that is causing a flight to safety, flight to quality, and we are seeing these events reverberated in the marketplace. So this is a confirmation on the fundamental side as to what we're seeing in the technicals. So looking at gold here, very bullish price action. We see here we dip down into this fair value gap. Price was unable to even get the consequent encroachment. And as I've shared with you all, that's something we use to measure order flow and price action. And then another thing is we were actually even unable to reach the upper quadrant. So we can even break fair value gaps down past consequent encroachment and look at the quadrants. So the upper 25 and the lower 75%. So we see here that price was actually unable to even get down to the upper quadrant, which is extremely bullish for price action. And then we saw that manifest in the coming weeks. And then price is traded lower down into this bullish propulsion block. Why is this a propulsion block? Because here's a bullish order block nested inside of another order block. So as I've shared in the previous analysis, I think on British pound, propulsion blocks, the sensitive levels in that is the high to the open of the candle. And then we see price traded down into that sensitive level. And then price has rallied higher off that. So now that we kind of have the context for gold from what's happened, we can now use our forecasting and anticipatory skills to determine what's likely to come out of that. So looking at gold dropping down into a daily chart now, there's nothing more here on a weekly. We have taken out this buy side liquidity here, and we are inside of these down close candles, while also inside of a breaker. So price has found support inside of the fair value gap and bullish breaker, and then price has rallied off that. So assuming we stay above these down close candles, I will anticipate continuation. The draw on liquidity would be these relative equal highs up here. However, I'm not sure how favorable that'll be, especially with the dollar rallying. And there was actually another key data point that I was looking at were GLD. GLD is the stock of gold that people can get access to the gold movement through a stock ETF. And GLD, the call option ratio on GLD actually has just exploded, meaning a lot of people are chasing this movement higher in gold. So what does that mean? If retail, if everyone's trying to get on the move in gold after it's already ripped almost 30%, I believe, off the lows, we're likely to probably see a retracement lower. So that's the only reservations I have about further upside continuation is these several technical factors. But as long as we stay above the breaker and fair value gap, we are seeing higher gold prices. If we trade below these key levels, then I will look for these relative equal lows to be taken. For our gold traders, though, something to monitor will be silver. Silver has actually not put in this higher high. So looking at silver, we are seeing a key SMT divergence that hasn't yet been completed, as we still haven't had a high and then a retracement off those highs. But as I said, we can anticipate SMT inside of key levels if we know what we're looking for. So here we see that silver has actually been unable to take out these highs, whereas the gold market has. So for our gold traders, this is something to monitor how silver trades. So a symmetrical market would be silver also making a higher high. Silver failing to make that higher high is problematic for gold's upside continuation. So if silver does get heavy inside of the SIBI and bearish order block in here, that would probably lead to more downside continuation in gold. And that'll also depend on what we see here in the dollar index. Christian Cadet, quick question, Dylan. When you either buy or short in the fair value gap, do you wait for price to come and break the fair value gap box, or do you simply enter on the 50% of the fair value gap? Just for more technicality, thank you. Yeah, so that's actually a great question, Christian. When I'm looking to enter, I only buy down close candles and I only sell up close candles. So I like to, if I'm going long, for example, let's look at the ES, and then I'll actually get into the balanced price range that I was being asked about as well. Okay, awesome. So let me just show an example from an intraday chart this week. This was something I was looking to trade. Drop down on a 1 minute. And then Tuesday, I believe, was the setup. Okay, here it is. Beautiful. Okay, so here's an example of how I trade the fair value gaps. So this was a quick scalp I took. Actually, ICT went over this trade here in a live stream, so I didn't take it when ICT's live streaming. I'm just focused on studying and gleaning the insights he's giving. But this is a trade I actually took, a quick scalp from this volume imbalance to actually take out the sell side liquidity below these relative equal lows. So when I'm looking to short, I want to short as we're trading up into the premium arrays. So when this was a bold-faced blue up close candle, that's when I'm looking to short. I don't want to short as the market's dropping, because then that will open up the dealer spread on me as well as the slippage. So whenever the market's going up is when I sell. Whenever the market's going down is when I like to buy, because that'll give you an advantage in your entries that most traders don't know about in terms of positive slippage, as well as making sure you're not chasing price. So you usually get a better fill, make sure you're not chasing price, and it gives you the best price available in the market at that time. So the same way I use this volume imbalance for my entry, you would use the same thing for the fair value gap. So depending on the circumstance, sometimes I want an aggressive entry. So looking, another trade I took this week on Wednesday. No, after Wednesday, on Thursday it was. Okay, we'll look at Friday's trade, because that one, I just used actually a breaker and a volume imbalance on my Thursday's trade. I was just remembering. So we'll look at Friday's, where I actually did enter short on a fair value gap. Beautiful. So this was the quick scalp I took here on the 1 minute. Just for quick reference, we see buy side liquidity was purged, just moved lower, and then we got another displacement, shifting market structure. So I actually sold short this fair value gap. So looking at this fair value gap here that I sold short into to attack the sell side liquidity below here, I entered at the higher end of it because we have this mitigation block. This is a mitigation block because it doesn't make the higher high. So I entered short on this fair value gap, but I didn't enter at the low end. Why? Because I had a feeling that it was likely to trade up into the mitigation block. So I entered short in the upper quadrant of it, expecting that higher end to be delivered. So that's why I personally, depending on the context, like to enter aggressively at the low end or at the high end. So this was one short I took just for a quick scalp. And then this was actually another trade I took here, short. So obviously you guys can see my bias was short going into Friday session. It didn't give any sustained price rallies, but it was already a sloppy seek and destroy session. So I was just looking to get in, get out, real surgical strikes. So in this example, here you see an example where I entered at the high end of the fair value gap. This is an example of me entering at the low end, and I'll explain the reason why. So here, the PD array that I was looking to also enter off was the mitigation block. So that's why I waited for the high end. But here we see we have a balanced price range, two fair value gaps that overlap. So we see price is unlikely to trade deep into this because we have the balanced price range. So as soon as we traded right into this level, I hit the buy button just because, as I said, it's an up close candle. I like to sell up close candles, and we have a balanced price range. So I wasn't expecting price to dig too deep into these key levels. I took my 5 handles, closed the charts, and then I enjoyed the rest of my weekend. So that's how I trade fair value gaps. So it really depends on the context. I hope that answered your question, Christian. Thank you. CRY, what are the best time frame combo for intraday? So it really depends on you, my man. What time frame do you like trading on? So you guys see how I do my intermarket analysis, and top down, I'm going from a weekly all the way down to a 1 minute. I personally like to enter and trade the 1 minute chart, but just because I enter on the 1 minute doesn't mean my analysis lives on the 1 minute. You guys see in the examples I did that I counseled you guys to check out, where was most of the analysis being done in that trade? It was being done on the daily and then the 5 minute. So I like looking at the higher time frame charts to confirm what I'm looking at in my 1 minute entry. Because if you're just looking at the 1 minute, you're basically trying to see an entire forest with your nose up against one tree. It's really difficult to have the bigger picture. So that's why it's really important to do top-down analysis. So my advice for you for the best time frame combo, you want to minimum have 3 time frames. So let's say you're looking to trade the 15 minute. That's what you're comfortable. That's what you like doing. You want to look at the daily, the hourly, and then the 15 minute would be your entry time frame. So you would need 2 higher time frames above that to complement your analysis. And then you would apply that same logic to any other time frame you would want to look at. So with that being said, now I will actually go into the live trade I took this week that was actually in line with my A+ trading entry model. And then we'll go ahead and take a look at that, and I'll share with you guys how I incorporate my time elements into price and how you can get high probability trading by combining time and price elements. Alrighty, can everybody see that screen all right, the recording? Okay, awesome. All right, let's get right into it. So you guys already know my model. As I've said, it would be wise to watch it before looking at this. So you guys already have the context of what the model is. So I'm not going to explain that too much. I'll counsel you guys to check out that video, as that was really helpful for traders to help build their own model and also analyze what a complete model looks like, from entry to exit, stop loss management to trade management. All those different components need to be defined in a model before the trade. A lot of people get in trades and they're anxious, they're uncertain, and that just simply stems from not knowing what you're doing. You have to know before you enter a trade where you're going to get out, where you're going to take partials, how you're going to move your stop loss, and all that needs to be determined ahead of the trade to eliminate all the guesswork and anxiety that may be inducing behind risking capital in the markets. So let's get right into it. This is a last hour macro trade. I like to trade that last hour, 3 to 4 o'clock in the afternoon, as there's usually quite a few setups forming during that time that I like to engage. It's a real quick time window, a kill zone that I like to get in, engage, get my money, and get out. So we'll go ahead and take a look at this trade now. That's in line with my ideal entry model. So keep in mind the time elements as we're watching this. We see now we're entering the last hour macro, which is 3:15 to 3:45. That's a sweet spot for setups to form in the last hour. So the higher time frame bias, we see the relative equal highs here on the 5-minute chart. That's my draw on liquidity, or where I think the market's going to go to. So that's what I'm keeping in mind. And then also, if we look at the 15-minute, we can't see it too clear here, but you can clearly see bullish order flow. Down close candles supporting price, and prices continuously driving higher. So I do have higher time frame sponsorship behind this 1-minute trade. So we see a 3 drives pattern, sell side liquidity taken out. We have this 5-minute fair value gap here in the shaded blue region. and then price is now traded above that 5-minute fair value gap. So that is indicating to me that price is now bullish because we're now trading through premium arrays, and I would want to see price support that. So you guys see here, I place my entry right here at the bullish breaker inside of the fair value gap. An aggressive entry would be entering on the breaker. However, I like to be more patient and I want to let the price come to where I want to do business at, and that's at the fair value gap level. So if I miss the move, I miss the move, that's okay. I like to be more patient and selective with my entries. So my entry was inside of the 1-minute fair value gap here. And one thing I do want to take our attention to, if you see the setup where the vertical line is right now, you see that there is a fair value gap and there was actually a market structure shift. So now that that vertical line is off, why did I not take that trade as the buy signal? And how did I avoid a stop out? Because you can look at that price action and say that's the model. We have sell side taken, we have a displacement higher and a fair value gap, but we see that price then traded down through that and made a lower low. The reason I was able to avoid this stop out is because time was not in agreement with price. We see that we were not inside of that 5 o'clock window. It was a pretty choppy day for the most part. So you need to make sure that the time elements are blended with price for setups to be high probability. So that's how I was able to avoid a losing trade, is by making sure that time is in agreement with price. So I got my entry right there that filled me. So my first partial is 5 handles. I have a funded account, which I'm working with, which I just looked to book my 5 handle profits. And then I close out after that. And then on my personal account, which I do trade derivatives, options, I do hold for the full pull. So my entry wasn't here. The reason I said in the text I want to see speed and movement to the upside is because the time of day we're getting into. We've already shifted market structure, traded down into a breaker, so we should be initiating the expansion phase of this price movement. So now we have traded above this down close candle, so we'll treat that as a bullish order block. So as you can see here now, I've adjusted my stop from here to here. So one thing I want to point out is with the stop management, I'm not in a hurry to jam the stop above break even, because what you'll see is today's a pretty sloppy technical day. So today was a pretty sloppy technical day. So you're going to want to not jam the stop higher, and you're going to want to just move it higher incrementally. And the reason I moved it then is because we just ran into new buy side. We just taken out newer highs. So I'm going to adjust the stop, but I'm not going to hurry up and put it to break even. As you'll see here, price does trade lower, but I'm not concerned with my stop because it's not really close to the market price. And then my ultimate target is the external range liquidity, where I said close position here. So what you guys will notice here is we hit that high and then we have an immediate drop off that high. What is that doing? That's inducing retail shorts. So if smart money is trying to buy at these attractive prices, because they know, like we do, it's very high probability to go above buy side, they're going to need to sucker uninformed street money to look to short so they can be the counterparty to that long. So we see here prices dropping down into the order block, but you see my stop loss isn't close to where the price is trading at now. So there's no anxiety or concern for me because my stop loss is well out of reach. I've already banked profits as a partial, and now I'm just going to allow retail to be taken to the slaughterhouse. And then the algorithm will not waste any time and it will immediately reprice through those highs to take that buy side liquidity. And then we can also see that bullish order block, no bodies have closed below it. We're able to trade into it with the wicks and we find support, and that's okay. But we do not want to see any body closes below that order block. So order flow is still bullish to me on the lower time frame. And now we have formed another down close candle. We've pierced the opening of that down close candle, which I would now consider a bullish order block. What you'll see I'm measuring there is the wick, that long wick we did down. I'm measuring the 50%. And you'll see here the price stopped right at that bullish order block and the 50% of the wick. So while I'm in trades, I'm also monitoring several data points to confirm that I'm on side and that price is still respecting discount or raise, showing bullish order flow. So the reason I'm saying give it 3 minutes is what I apply to my trades is called the time filter. The time filter simply means that if it's not moving in my direction, I'll say, okay, price has 3 minutes to show me I'm on side. If not, I will just simply close out because I've already banked the partial. I don't want my stop to be tripped. So I will give price a little bit of time to show me I'm off sides, or I will close out. And then here we see price expanded higher and traded into new buy side. So what you guys will see here is now my stop loss has been moved up to my entry. So now the stop is at break even. Why did I move the stop to break even then? It's because new buy side has been engaged. So now I feel confident moving that stop loss to break even. And as you guys can see, it's nowhere near market price. I'm not concerned about my stop loss. What I'm focused on is managing the position by looking at order flow and making sure it's still giving me signatures that I'm on side. So stop rolled to break even, and then I noted pay attention to the time. We're entering into that 345-minute window where price does like to expand into the premium objectives. So I'm constantly referring to time first, then price elements. That's the key when trading ICT and smart money concepts. So as you guys can see, I'm not in a hurry to move my stop higher. It's still well out of reaching distance from price, so I'm not concerned about it. As you see here, I said the dollar is rallying. This is the last chance for price to go up. So also while I'm in these trades, I'm monitoring the dollar index. Is the dollar bearish? That will put, assuming the dollar is falling, that'll pour gasoline on top of my long S&P trade. So I'm constantly referring to intermarket analysis, just like you guys see me doing here on our pre-market prep. I'm also doing those same things intraday to confirm I'm on side. So with the dollar rallying and the time of day we're getting into, I wanted to see immediate feedback that I'm on side, or if not, I would close out the position well in profit. But then we see price here, the volume imbalance that I drew out. We see the bodies are respecting price beautifully. So it's still giving me that confirmation that I'm on side and the market is still in a buy program. So price finding support inside of that volume imbalance, as I would anticipate. You guys can see all the down close candles are supporting price. So order flow is still bullish. So now we've formed another bullish order block. So I would expect that down close candle to support price. Stop loss still at break even. I don't want it to be a factor. I don't want to be concerned with it. So aggressive expansion higher into the buy side in 1 minute. Note the time aspect here on the bottom right of the chart. We're entering the 3:49 hour. So there's a macro at the 50-minute that will make price expand into whatever liquidity hasn't been taken. So how did I know price was going to expand aggressively before it did? Using time elements blended with price. And then this is the analysis of the trade I did after the fact. But I did want to share this recording with you all because I know you guys see a lot of my static charts and after the fact, but I want you guys to know that a lot of this is not hindsight. A lot of this is traded live. And that's exactly how I manage a trade and what it is that I look for. So actually shifting back to the recording, 3 p.m. candle power of 3. We have the opening at 3 o'clock. We have the Judas swing lower. And as I've said in the A+ setup video that I shared with you all, that we anticipate power of 3, and it's not limited to a daily chart. You can apply it to 4-hour candles, 1-hour candles. So I can trade a 1-hour candle as if it were a daily using power of 3. So we have the opening price at 3, our Judas swing manipulation lower, and then I'm looking to get on board for the expansion move into the draw on liquidity. Awesome. So I think that'll conclude this session. Hassam, I've already looked at the euro, brother. You can go ahead and take a look at the recording. It'll be uploaded right away. So with that being said, thank you all very much for sharing your time here with us and for engaging in the chat. I appreciate your guys' participation, and thank you for joining us. As always, feedback is appreciated. So if you guys would like to see different things, incorporate different teachings, we're always open to feedback, and we're always looking to improve what it is that we're doing here. So with that being said, everybody, thank you all for your time. Thank you for sharing it with us. I wish everybody a profitable trading week. So have a great week. Be safe, everybody. Thank you.